In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. Economic activity continued to expand at a solid pace in the fourth quarter of last year, with GDP rising at 2.3%. Recent indications, however, point to a moderation in consumer spending following the rapid growth seen over the second half of 2024. Surveys of households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal.
Coming up today, stocks rally across the board. The Fed turns dovish. Their latest dot plot, fear still dominates. The latest from the Bank of America CEO. And did we just see the waltz bottom for Tesla? You don't want to miss this one, guys. Let's go. And look at that, once again, Wednesday, we're ripping up here on a repeat of this hump day pattern we've been seeing pretty much all year. Seeing the stock market rallying higher on Wednesdays after starting soft for the week. Pretty nice broad rally out there today. Most sectors finishing in the green, especially growth and tech as well. And stick with me today because we'll take a look at whether the would-be vice president of the States potentially done us bulls are solid today and maybe marking a low in the stock. But first, let's just take a look at the market, what came out of the Fed and some key reactions. Looking across a bunch of different assets. Like I said, Wednesdays now tracking at an annualized rate of 103%. Typically Thursday, the second weakest day after Mondays. And thanks to a few good last Fridays, we're getting a bit of a bump up going into the weekend of late. And so once again, we'll take a look at whether we did see the bottom last Thursday afternoon. Because if so, that would be following seasonality, looking back the past 20 years. Quite often consolidate, pull back in Q1, only to find a bottom in mid-March and have a pretty good rally going into April. But plenty of people don't seem to think so. In fact, still in the extreme fear zone down here in 22. Kind of been stuck here for a few weeks now. And pretty much all the sentiment surveys out there amongst investors have got bullish readings at some of the lowest levels, coinciding with previous crises throughout the years. But is there a disconnect between uncertainty, fear, and how people are feeling and what's actually going on in the markets? Well, looking at this chart here in the green, US Economic Policy Uncertainty Index, obviously really elevated at the moment. In the dark blue, US investment grade corporate bond spreads over top of Treasury. Barely 100 basis points, and that would typically spike with economic policy uncertainty. However, we're really not seeing that at this point in time. So which one of these lines is correct? Everyone worried about what might happen with this new admin, or what one of the largest, most sophisticated markets in the world is pricing in? Because big, large bond investors are not demanding a premium to lend money to companies here over top of Treasuries. And so the S&P 500 just did a 10% correction, even more so for the NASDAQ, Russell, and growth stocks. But looking back in history, when we get a double-digit down year, pretty much all the time, it's for a big reason. There is plenty of logic in the market when you step back and kind of look at the medium long term. Whether it's depressions, global conflicts, recessions, the bursting of bubbles, a financial crisis, or inflation as well. So if we were going to have a big down year in the market this year, down 20% or so, is that just going to be because of tariff fears? Because remember, unlike other crises, these can be reversed with a stroke of a pen. In fact, we just heard White House economic advisor Kevin Hassett spent last night with the Commerce Secretary and Treasury Secretary negotiating with other countries about mutually lowering tariffs before they're set to officially kick off on the 2nd of April. Still possibility for a last-minute deal. If not, they will go ahead, but at any given time, big deals could come out, even after they go into effect. I do believe they're negotiating tools, and the new admin won't stop until there's a level playing field. And just listening to the CEO of NVDA, he thinks tariffs are no big deal in the near term, saying AI is the foundation, the operating system of every industry going forward. We are enthusiastic about building in America. Partners are working with us to bring manufacturing here. In the near term, the impact of tariffs won't be meaningful. Now remember, he's got to be really careful with his words and what he says. has a fiduciary responsibility to his shareholders to be open and honest and give forecasts for what he sees. So that was a pretty good sign to hear from the godfather of AI. And by the sounds of it, he's working with the rest of the industry to dial up production on US soil. Just looking at the stock price, still a little muted throughout this AI conference that they've been hosting, unveiling a new super chip named Rubin. Market just seems to be pumping the brakes a little bit for the here and now, at least, with getting excited about this. Things still obviously a little on edge. The VIX did manage to get below 20 for the first time in a few weeks today, but the term structure is still a little flat. Front month and second month, VIX futures still at parity here. But I'd say after today, the chances that last Thursday was a bottom have increased once again. S&P 500 index just put in high highs, high lows, and we did take out those highs from Monday. Whilst breadth is dramatically improving up the front and across the board as well. Also seen a nice bounce back in the key sector financials. Finding its feet there mid last week, and we just heard from the Bank of America CEO today. He said economic growth is better than people think, and the Fed should stay on hold. Thinks GDP growth will still come in this year on a two-handle, and I agree with what he said here, kind of similar to what we've been talking about lately. We're in this classic moment where the consumer is saying, I'm getting more pessimistic in some of the surveys and things like that. But if you actually look at what they're doing day to day, they continue to spend, which means the economy ought to be holding up better than people think. And he's not alone. We've also seen a sharp uptick in corporate insider buying throughout this pullback, as they're quite often contrarian in their trading activity. Looking back in history, when we've had similar readings on sediment traders, proprietary corporate insider velocity index, they have marked the lows or near lows in the S&P 500, coinciding with excessive pessimism as well. In fact, this signal, the market was higher a year later, 4 out of 4 times, and sometimes very much so. And with this pullback we've had in the markets, this current bull market is only up 58% since October 2022. Looking back in history, there was only one prior bull market that finished with a lower gain than that, back in the mid-late 60s, 48%. Otherwise, the average bull market tends to give us 192% of gains. But like I said yesterday, it already seems like a foregone conclusion. Tariffs are bad, the bull market's done, we're looking at a recession and the end of US exceptionalism, as Chinese and Europe stocks are outperforming this year. But I disagree. Just because one market's been outperforming for the last 2.5 months doesn't mean US exceptionalism is dead, and doesn't mean China and the States can both perform well at the same time. It doesn't have to be an either-or situation. Like I said, don't be surprised, and in fact, I'm expecting eventually big blockbuster trade deals, and maybe done with the Chinese first. They very well may look to step ahead of the Europeans, and then eventually Europe will be forced to come to the table as well and get some deals done. But for the here and now, international stock market do continue to hold up well. Looking at the developed markets, ETF here, and even emerging markets, with Chinese making up the majority of them, holding up pretty well this year. While just looking at the Russell 2000, for example, bit of a different look, pretty much pulled back ever since the election. But we are getting some good technical signs here, starting to look like pretty sharp bullish divergence on my DSI indicator here. And the Mag 7 could be grinding here on volume, which we typically see in bottom. But just moving over to the Fed and what we heard from Jay Powell today, did actually come out pretty much as expected. Like I said yesterday, he was going to talk about heightened uncertainties, pessimism, sentiment, a little softness in consumer spending, did actually lower their economic outlook a little, maybe even setting up a lower hurdle to jump over to get a rate cut done, and maybe why the market interpreted this favorably today. Kept rates on hold, said the labor market's solid, pointing to some inflation risks, but still says he has confidence in inflation coming down. Even was gutsy enough to use his previously mocked terminology, inflation is transitory. He said these tariffs could very well just be transitory. And like I said, he's just going to keep walking the line, staying on non-hold mode, waiting for more data before making his next move. However, like I said, I think it was a little dovish, even though the latest Fed dot plot, where their members think the path for interest rates is going to go, was pretty much unchanged from December here. They still think we're on a path down to 3% come mid-late 27. No surprise to see that a bit higher from before the election in September. They were always going to talk about inflation in this outcome. But what was also interesting is they decided to slow down the pace of quantitative tightening. That means how fast they're reducing their balance sheet. Pretty sizable, reducing it by $20 billion a month from 60 down to 40, and that's only with $5 billion of treasuries being offloaded per month. Previously $25 billion. And so that's kind of bullish, a form of boosting liquidity. Basically slowing down the pace of offloading treasuries onto the market. And going down to a 5-minute chart here, probably why as soon as he spoke, yields just nosedived. Because like I said, even though he mentioned inflation, probably just to cover himself, acknowledging fears with tariffs, probably uncertain himself. To me, overall, it was a bit dovish, especially on their balance sheet side of things, and lowering their GDP growth forecast to the high ones. Like I said, I think it just sets them up potentially getting a cut done in the next couple of months when all the dust from these tariff storms settles down a bit. And the market pretty much agrees on that as well. In fact, we got better than 2/3 chance we'll get a cut in June, approaching 1 in 5 chance in May. But the market thinking we could get 3 cuts this year, even though the Fed dot plot, Fed members themselves are thinking we're going to get about 2 cuts this year. They just want to make sure inflation doesn't spike and very well may be waiting for tariff deals to get done themselves. Because when we eventually get big deals done on tariffs, inflation fears and expectations will come right down, and current inflation in the real economy is running low on a one handle. That just opens the door for rate cuts, and the technical soft landing that we're in can continue. But if we did run into trouble this year or next, Fed will still have 350 basis points in their back pocket to work with, in addition to quantitative easing. And just looking at their official statement, the only 2 things that pretty much changed is they added in uncertainty around the economic outlook has increased, just acknowledging what's occurring in surveys and in the markets, and then also adding in slowing the pace of their balance sheet reduction, which, like I said, is a bit of a cushion for the market. And looking at the price action in high yield bonds, that was very much welcome. Pretty decent move here, coming off those sharp lows from last week, showing the bond market's feeling pretty good about the current risks in the economy and the Fed's actions. But we're still going to get past April 2nd, when reciprocal tariffs officially kick off. Can we get a deal by then? Market could very well remain a little nervous until then, and the Fed still not really giving clear indication of when they're going to move next. But I think it's setting up favorably, especially if we get any positive developments on tariffs. Could be an interesting next week and a half. Triple witching this Friday. Next week, the last week of the first quarter, which we can often see big rebalancing in the market. Now, just moving on today to what a lot of people in the financial community are talking about. The would-be vice president of the United States, who lost in spectacular fashion in November, just came out at a conference today talking down Tesla, saying that he's enjoying watching the stock go down every day, and in fact, even encouraging Tesla owners to pull the logo off their EVs. And he didn't just mention this casually at a conference, he actually posted it onto his X account here as well. Kind of crazy if you ask me, a would-be vice president openly calling for the destruction of the most American-made car there is. Not to mention, a lot of Americans exposed to Tesla's stock price through owning the S&P 500, given it's one of the biggest holdings in there, for which this has caused a lot of backlash on him. Just looking at all the comments, more and more people coming out in support of Tesla because of this. Funny to see the stock up pretty strong today. And there he is making a bit of a hand gesture, but of course no one's got any problem with that, right? It's only if Elon Musk does it. But it's not just him, plenty of others as well, like Jimmy Kimmel, sarcastically saying, please don't vandalize Teslas straight to the camera. Once again, trying to motivate the deranged and deluded from doing exactly that. But just stepping back from the clown show a bit and looking at the actual numbers, we just got data in from China on how the new Model Y is doing over there. Absolutely smoking the competition, almost 10x, the second most popular electric SUV over there. Really good sign to me on what's arguably their most important market, most potential, growing the fastest, which unlike many Western brands, do not have a good foothold in. And so Tim Waltz, like Jim Cramer, can kind of represent peak mainstream sentiment. When you have a guy who has no business talking about stocks, he doesn't even own any, financially illiterate, jumping on the mainstream media narrative, it can be an indication that things may have reached a peak. We could be in the process of making a bottom here on Tesla, especially looking at my DSI. We've got another sharp bullish divergence here as the stock's been grinding sideways for a week and a half now. Getting a bit of volume here as well. My institutional buying indicator trading up to 59% and good seasonality over the coming couple of months as well. Plus, we've already come down more than 50% from its highs late last year. Gives us reasonable chance we could be in the process of forming a bottom kind of here in the 220s, 230s. I may not get a chance to reload again at 188 as much as I would love to, because I think a guy like Tim Waltz just makes for a great contrarian indicator. And I'm pretty sure in 5-10 years time, we'll look back on this period in Tesla, and if we even remember it, we'll probably just laugh at how insignificant it truly was. But anyway, the hate is going to hate. Us bulls are not going anywhere, and I wouldn't be surprised to see the stock price of Tesla hit $1,000 next year or potentially in 2027 in the lead up to the release of the Optimus bot on top of the launch of Robotaxi just around the corner as well. Now, it's getting back into a few charts. High beta versus low volatility could also be in the process, potentially making a bit of a bottom here. The sharp pullback we've had, even deeper than the 5th of August. All sectors finishing in the green today except for consumer staples. Actually pulled back sharply last week. And mega cap tech still trying to find its feet there. There's Apple. Alphabet, Google starting to look good. Amazon and Microsoft still have yet to stage a decent bounce. We haven't really had that big, strong green candle of a day on monster volume where everything across the board rips up, led by growth. Along with VIX probably getting down to a 16-15 handle, along with the term structure back to a normal state of contango, then we know for sure the bottom is in. But after today, I think the odds have continued to build in favor that we did see a bottom on Thursday. However, I would still give us maybe around a 30-40% chance we at least come down and retest this. Like I said, until we get that big push-up green candle, still a reasonable chance we come down and retest those lows, and a small chance we even take them out as well. But bearish sentiment has been peaking, and like I said, we've got OPEX this Friday, last week of the quarter next week. Some big funds might actually be mandated. Buy stocks and sell bonds, especially with pullback in yields today, and the Fed potentially lowering the bar to do their rate cut as well. The market liked that. But of course, tariffs is still day to day, still going to get knocked around by those headlines as we approach the official deadline when they start April 2nd. Market will still be at least on edge until then. Otherwise, we'll keep playing it as it comes. As always, I'm interested to hear your thoughts. You're welcome to post a comment below this video. I read everyone, and thanks to you all for tuning in and hitting that like button. I'll see you this time again tomorrow. Cheers.